Welcome to the deep dive. You're here because you want to stay sharply informed. And today, we're digging into ITC's Q1 FY26 results.
That's right.
Our goal, really, is to cut through the numbers, pull out the key insights, and help you understand what's actually going on with this latest update. Let's just jump right in.
Absolutely. It's crucial to unpack these details, understand the bigger picture. We'll go piece by piece, build it up.
Unpacking the financial summary, consolidated and standalone performance.
Okay, let's start big picture then. The overall financial summary for Q1, consolidated and standalone, what's the immediate takeaway?
Well, the first thing you notice is it's a pretty resilient performance, especially given, the tough environment they're operating in.
Resilient how?
Strong top-line growth, definitely. But, and this is the key tension, there are these persistent margin pressures kind of pulling things back. That really shapes the whole story of the quarter.
Okay, that tension. Let's unpack that. What did the consolidated revenue numbers actually look like? Walk us through those.
Right. So on the consolidated side, gross revenue climbed pretty impressively, over 23,000 crore rupees.
Wow.
Yeah, that's up nearly 20% compared to last year. And net sales, after excise, also up strongly, 21% year-on-year. So, good momentum there. Shows demand is holding up.
That's significant growth on top. But the big question always is how much of that actually hits the bottom line? How did profitability hold up?
Yes, and that's exactly where you see the headwinds kicking in. The cost of goods sold, basically. What it costs them to make their stuff surged massively, up 40% year-on-year, 40, which, massively outpaced that revenue growth we just talked about.
Right, so that means?
That means gross margins got squeezed pretty hard. They fell to just under 52%.
So down from what, roughly?
Down about 6.5 percentage points from last year. That's a big hit. Now, they did manage other operating costs okay, but the overall operational profit margin, EBITDA margin, that contracted too, down to 31.9%.
So a drop of over 4.5 points there too.
Yep, exactly. It just confirms, strong sales are great, but they were definitely diluted by those rising costs.
Okay, so given those really quite intense cost pressures, sounds like a tough fight, did they manage to protect the net profit at all?
They did, actually, which is quite remarkable. Despite all that, the adjusted net profit came in around 5,176 crore.
Right.
That's still up over 5% from last year. And profit after tax was just under 5,350 crore, up nearly 5% year-on-year as well.
So they found savings elsewhere. Or just underlying strength.
Yeah, it really shows some strong resilience, maybe some really good cost discipline in areas outside of just making the goods,
Right. Now, sometimes the standalone numbers for a big group like this tell a slightly different story. What did we see there? Same picture.
Pretty much mirrored the consolidated trends, yeah?
Yeah.
Strong top-line growth was there again, but the growth margin decline was even steeper on the standalone side. Yeah, fell to just under 49%. That's a 7.5 percentage point drop. And maybe more critically, the adjusted net profit was basically flat, up only about 2% year-on-year.
Flat bottom line despite strong sales.
Exactly. That flat profit really signals how much those margin pressures are eating into what should have been really good earnings growth from their core operations.
Diving into segmental performance analysis. Consolidated.
Okay, so we've peeled back that first layer, but ITC is, it's a beast, right? So many different parts. We need to go deeper. Which bits are driving growth and where are the real challenges lurking?
Yeah, this is where it gets really interesting. The segmental performance.
Yeah.
Honestly, it was a bit of a mixed bag this quarter.
Mixed bag how?
Well, we saw some good recovery across most areas, but those margin pressures we keep talking about, they were definitely hitting several key segments.
Okay, let's start with the core then. FMCG, cigarettes. Always the big one. Story there.
Cigarettes were pretty steady, actually. Net segment revenue over 9,500 crore. Yeah, up a solid 8% year-on-year. Mostly volume-driven, it seems, helped by their premium stuff and, efforts against illicit trade. Tax stability probably helped too.
And profit from that segment.
Segment PBIT, operating profit, grew about 5%. Margins saw a little squeeze, down slightly to 57.6%. They mentioned using some older, higher-cost tobacco inventory.
Oh, okay. So legacy costs hitting there.
Yeah, but they did say new procurement prices are easing a bit, so maybe that pressure lessens going forward.
Okay. What about the other FMCG, the others category, biscuits, soaps, all that stuff?
Right, FMCG, others. If you exclude notebooks for a second, revenue growth actually picked up nicely, up over 8.5% year-on-year.
What drove that?
Staples, biscuits, dairy, premium personal wash, home care, pretty broad-based. And what's really interesting is the growth in their newer channels, you know, e-commerce, quick commerce, plus those digital first brands like Yoga Bar and Mother Sparsh.
Yeah, you mentioned those.
They've hit about 1,000 crore annual revenue run rate, ARR, collectively. That's quite something.
But the profit side, still feeling the pressure.
Definitely. Segment PBIT was actually down about 17% year on year. Margin squeeze under 7%.
Ouch. Why the drop there?
Challenges, really. Low-priced imports hitting the notebooks business hard. Unseasonal rains didn't help. And still, high commodity prices, edible oil, cocoa, things like that.
So what are they doing about it?
They mentioned cost management, pushing more premium products, and careful price adjustments, trying to balance it out.
Okay, busy times in FMCG. Let's switch gears. Agribusiness. Often volatile, right?
Agri was the real standout this quarter, no question.
Standout good or bad?
Oh, standout good. Revenue surged to over 9,700 crore.
Get out! How much is that up?
It's a staggering leap. 163% quarter on quarter and nearly 40% year on year.
Wow. What drove that?
Seems like really agile execution on trading opportunities in bulk commodities, plus strong leaf tobacco exports helped too. Their operating profit was also way up.
Okay, but there's always a but, isn't there?
Yeah. Well, yeah. Despite that massive revenue jump, the operating margins actually declined, fell to 4.5%.
Huh. So moving huge volumes, but making less on each unit.
Exactly. And suggests maybe the trading business itself has lower margins, or perhaps those wheat stock limits that came back in June had an impact. Volume up, but profitability per unit under pressure.
Interesting dynamic. Okay, next up. Paperboards, paper and packaging. How did that segment fare? Often linked to global trends, right?
Yeah, and it faced some serious headwinds this time. Revenue is up slightly year on year, about 7%, but the operating profit, EBIT, it just collapsed. Down over 40% year on year.
40%? What happened to margins?
They fell off a cliff, pretty much. From 13% down to just 7.2%. A massive drop. Nearly 6 percentage points.
What caused that?
It's a classic squeeze. A flood of low-priced imports hitting the market, combined with high domestic wood prices. Like fighting with one hand tied behind your back.
Sounds tough. Any bright spots?
Specialty papers did show some decent growth. And the company says they're talking to policymakers about, trade remedies to try and level the playing field.
Right. Finally, the others segment. What's in there again? And how did it do?
Others includes things like the ITC Grand Central Hotel operations, ITC Infotech, and their newer food tech business. Revenue there was healthy, up 22% year on year to over 11,180 crore.
And the profit?
EBIT actually fell compared to the last quarter. Margins dropped quite sharply sequentially, down to about 13%.
Why the drop there?
Well, a big factor is the demerger of the hotels business, which technically took effect Jan 1st, 2025. That makes the year-on-year profit comparisons a bit tricky for this segment right now.
Exploring key strategic insights and management commentary.
Okay, so we've gone through the numbers segment by segment. Strengths, weaknesses, pressure points, it's all there. Now let's zoom out a bit. What's the company saying about all this? What are their strategic insights? How are they planning to navigate?
Well, the management definitely acknowledged the headwinds, global stuff, geopolitical tensions, but they framed their performance as resilient. What's quite interesting is their positive view on the Indian economy itself.
Oh, yeah. What are they seeing?
They highlighted buoyancy in agriculture and services, inflation moderating a bit, rural wages picking up. They seem pretty optimistic about a normal monsoon and seeing early signs of urban consumption recovering too, all good signals for their markets.
So a generally positive backdrop in their view. How does that feed into their strategy? What's the game plan?
Their big strategy banner is IPC Next. The pillars are future tech, consumer-centric, climate positive, and inclusive.
Okay, sounds comprehensive. What does that mean in practice?
It means focusing on innovation, making supply chains really agile, pushing a digital-first mindset everywhere, hitting their big sustainability 2.0 goals, and just keeping a really sharp eye on costs.
Got it. Let's get specific again. FMCG facing those margin pressures. How are they tackling that strategically?
For FMCG, a big push is on what they call portfolio premiumization.
Selling more fancy stuff, basically.
Pretty much, yeah. Focusing on higher value products. They're also really leaning into those newer channels, e-com, quick commerce, modern trade, and those digital first brands we talked about. Key drivers.
And the costs.
Tackling that with a smart net revenue management, which sounds like careful pricing, plus calibrated price hikes and strict cost controls. They also launched over 100 new products last year, so innovation is clearly part of the plan. Investing more in brands like Ashervad, Bingo, Vivell, too.
Okay. And for cigarettes? Strategy there beyond just selling more.
Main focus seems to be fighting illicit trade. Strategic interventions in key competitive areas. They feel the stable tax situation helps, and they're looking forward to that track and trace system getting stronger to help fight fakes.
Makes sense. What about agribusiness? Stellar performance, but how do they keep that going?
Strategy there is all about that agile execution on trading, using their sourcing network, which is increasingly digital. The standout is that ITC Mayor's platform.
The digital thing.
Yeah, the tech-driven agri-solution. It's scaled up massively. Apparently, it's now sourcing like 40% of the wheat for Ashirvad Atta. That brings big efficiencies.
Impressive integration. Now, paperboards where margins got crushed. What's the plan to fix that?
Well, part of it is external actively talking to policymakers, pushing for those trade remedies against cheap imports.
Lobbying, basically.
You could say that.
Yeah.
Internally, they're working on enhancing their own plantations for sustainable wood supply and driving cost savings. Plus, they highlighted strong growth in sustainable packaging solutions that portfolios tripled in 4 years. So shifting focus, too.
Right. You also mentioned the food tech business earlier and others. Why is that seen as a significant new growth area?
Yeah, this is definitely one to watch. They're basically leveraging all their existing strengths, food science, brands, cooking expertise to get into the online food delivery market.
Cloud kitchens and the like?
Exactly, and they say it's scaling fast and in a capital-efficient way. GMV gross merchandise value crossed 100 crore last fiscal year. They've got about 60 cloud kitchens in 5 cities now, looking to expand nationally. It's a real diversification play.
Interesting. Finally, sustainability. You mentioned it in their strategy. Is it just talk or is it core?
Yeah, it seems pretty core to ITC. They have a long track record, triple bottom line focus. Water positive, carbon positive, solid waste recycling positive for many, many years.
Right, I've heard those stats.
Yeah, consistently high ESG ratings from global agencies. They're actively working on net zero operations and already get over half their energy, about 52%, from renewable sources. It's deeply embedded.
Understanding the outlook and valuation from research analysis.
Okay, we've heard the company side looked at the numbers, but what does the market think? What are the analysts saying? What's the outlook on earnings and valuation?
Generally, the earnings outlook from analysts seems quite positive, actually. They're projecting adjusted net profit to improve quite a bit over the next few years.
How much?
Going from around 19,600 crore in FY25 up to over 24,300 crore by FY27. That implies, an annual growth rate of EAGR of about 11.5%.
A decent clip.
Yeah, and earnings per share, EPS, projected to rise similarly. It suggests the business is really moving into a phase of earnings compounding.
But what about those margins? We keep coming back to them. Are analysts expecting a recovery there? Or is this the new normal?
That's the million-dollar question, isn't it? While profits are growing, the actual margin percentage, the EBITDA margin, has been a bit volatile. It peaked over 37% in FY24, slipped last year, and analysts see it hovering around, say, 33.5 to 34% through FY27.
So not back to the peak levels.
That doesn't look like it, according to projections. It suggests that maybe higher costs or the changing business mix, more agri, more FMCG spending might be structurally impacting that operating leverage.
Okay, makes sense. And how is the market valuing the stock based on all this? What are the multiples saying?
Well, the price to earnings, or PE multiple, has definitely come down from the highs. It was way up near 39 times back in FY21. Now it's more like mid to high 20s.
And looking forward.
Projections see it compressing further, maybe down to 24 times for FY26 and around 21 times for FY27 earnings.
What does that compression tell you?
Could mean a couple of things. Either the market thinks earnings growth will eventually justify the current price, or maybe there isn't much room left for the multiple itself to expand. Future returns might depend more heavily on actual EPS growth.
Interesting. Is it cheap or expensive now, relatively speaking?
Well, based on those FY27 estimates, it's actually trading a bit below its 10-year average PE. So not obviously expensive on that metric. The overall analyst view seems to be, look, Q1 showed resilience, showed strategic agility in a tough environment.
Identifying the tailwinds.
Okay, let's shift focus slightly. Every company faces challenges. We've heard plenty of those. But what's really working for ITC right now? What are the strong tailwinds pushing them forward?
Yeah, definitely some good things happening too. I'd say the first big tailwind is just their diversification.
The multi-business model.
Exactly. Strong growth in agri, FMCG others accelerating, especially premium and digital stuff. It provides stability, multiple growth paths. Second, you can't ignore the cigarette business.
Just a cash cow.
Absolutely. Still the key value driver, brings in over 80% of operating profit. The stable tax regime really helps its standing, and crucially, it funds those new business ventures.
Like food tech.
Like food tech, exactly, which is the third tailwind, these new growth vectors, food tech scaling rapidly, and also their nicotine derivative exports business is growing progressively. Fourth, those strong ESG credentials we talked about.
Increasingly important, right?
Definitely. Leadership there aligns with global investment trends, enhances long-term appeal. And finally, the macro picture for India, particularly rural demand, expectations of a normal monsoon, good crop sowing, that bodes well for FMCG sales, which rely heavily on rural consumers.
Recognizing the headwinds.
Okay, makes sense. Lots working for them. But now, the flip side. What are the headwinds? What are the major challenges they're really grappling with?
Well, number one, without a doubt, is that persistent input cost inflation. You keep mentioning it because it's hitting hard.
Edible oil, wheat, wood.
All of those, yeah. Cocoa, soap noodles. It's weighing heavily on margins, especially in FMCG and paperboards. Second big headwind is intense competition and those import pressures.
Particularly in notebooks and paperboards.
Exactly. Deflationary conditions in notebooks because of cheap paper imports. And a similar story impacting paperboards. Leads directly to that margin compression we saw, which is the third headwind, really the overall squeeze on margins.
Despite good sales growth.
Right. Gross and EBITDA margins contracted significantly overall, so they're finding it hard to pass on all the cost increases, or maybe the sales mix is shifting towards lower margin stuff. And lastly, maybe a smaller point but still relevant, is just comparability.
Comparability.
Yeah, the hotels demerger, recent acquisitions, they just make straight year-on-year comparisons for some numbers. A bit fuzzy right now. Need to be aware of that.
Key things to watch going forward.
Okay, this raises a really important question then. Looking ahead, bringing it all together, what are the absolute critical things we should be watching with ITC? What will really define their path in the next few quarters?
Yeah, what's fascinating is seeing how they juggle everything, right? The old strengths, the new pressures. Okay, key things to watch. First, absolutely number one, is their ability to mitigate those cost pressures.
Can they get margins back up?
Exactly. How effective will that smart net revenue management be? The premiumization push, the cost cutting, that's critical for margin recovery. Second, government policy, specifically on trade remedies for the paperboards industry.
Will they get protection from imports?
That's the question. It could make a big difference to that segment. Third, the scaling of those new growth vectors.
Food tech and nicotine derivatives.
Yep. Can they keep expanding them profitably? That unlocks future value. Fourth, always, cigarette tax stability.
No nasty surprises in the budget.
Hopefully not for them. Continued stable taxes and effective action against illicit trade are key for volume and revenue there. And fifth, just monitoring demand recovery, both rural watching wage growth and urban consumption trends. That gives you the pulse for broader FMCG sales.
So a lot hinges on execution and the external environment.
Pretty much. Overall, look, Q1 showed strong revenue momentum thanks to that diversification. But managing costs and competition is the core challenge right now. Their strategic moves, plus hopefully a stable economy and helpful policies, that's what they need to turn top-line growth into better profits and shareholder value.
Outro. So, as you think about ITC's journey, maybe consider this. How does a hugely diversified business like this really balance its traditional, very strong foundations with that constant pressure to innovate, to lead in completely new areas? It's a massive challenge, isn't it, for any big organization? And ITC is right in the thick of it. We hope this deep dive gave you some real insights into how they're navigating that.
Indeed. It's fascinating to see that interplay, you know. Global pressures meet domestic resilience, all reflected in these quite detailed quarterly numbers, really tells a story.
Well, that wraps up this deep dive. And just a reminder, we are not SEBI-registered financial advisors. If you are thinking about making any investment decisions based on this, please consult a certified financial advisor first.